It's going out there. It's October 18th. I'm Curzio, just the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. Wow, what a rally. Market's up about 6% in a few days. As earnings, at least the early stage, are coming in ahead of estimates, especially for banks. Banks are pretty much always the first to report. Remember how Alcoa used to be that. There's just so many stocks, but it's mostly banks that report first. So you got about 30, 40% of the S&P 500 reporting so far, or actually just 30 or 40 companies. It's very early in the season. So you have a lot more companies that report, especially later this week into next week. The next 2 weeks, we're going to get a real glimpse at earnings. The dollar is falling. Bond yields are easing, with 10 years now under 4%. And that's really the key to this rally. If you look at the dollar, it's about the dollar, about rates. That's what's really driving the equity markets, driving the markets as a whole. And we've seen the dollar continue to surge as we're the best of all the garbage fiat currencies. Everybody floods here when things are bad every place else. And it's been surging. That's definitely the key to the rally. And now you're seeing it bulls out in full force, which you can't blame them. I mean, most of these guys have been buying, or at least telling us to buy stocks, which I hope that means that they're buying as well, almost on a daily basis for months as the market's been crashing. And it's kind of funny when you think about it, right? How, bulls hate bears and bears hate bulls. That's just the way it is, right? Growing up. So I was fortunate where my dad was kind of a perma bear and Kerner was a perma bull. So to get both of those and learn under those two people and great people was amazing for me. It helped my career tremendously. I wasn't biased to anything. I saw both sides. I learned growth investing and value. I mean, value has been so out of favor for such a long time. Nobody even value. What are you talking about? I don't want value. Growth. That's all about. That's what we saw. But it's funny because when one jumps to the other side, it's like they're a celebrity. I mean, it's the same with politics, right? We're liberals, conservatives, we're no longer allowed to like each other, hate each other. When Bill Maher, who is a liberal, calls out the far left who wants to defund the police, rip down statues, have teachers condition your first grader, how changing their gender is okay. Fox News suddenly loves Bill Maher. He's all over TV, right? So when you flip-flop, it's kind of cool because everyone's like, oh, we love this guy now. But, get to the point, which is Mike Wilson, Chief Financial Officer at Morgan Stanley. This is one of the few investment banks, right, who runs the investment bank, Chief Financial Officer. I don't want to say runs CEO, but, influences decision when it comes to the investment side. He's calling for a major pullback for a while now. One of the only investment banks who's by far lowest estimates on the street. Not saying that others weren't predicting, but he was saying the market's going to fall a lot further. And he's been right. He's definitely been right so far. And again, low on the street. When we say the numbers are low on the street, that means they're the lowest from the estimates. Or they have the high of the street estimate. It means the highest of all the analysts when they figure out that earnings number or whatever, or even economists. The highest on the street is based on those estimates from institutions. And he was the lowest when it came to the market in the S&P. And how far it would fall. But now he's saying that, hey, we could see a 10% rally from here based on sentiment indicators, based on what we've seen in the past. Maybe earnings come in a little bit better than expected, and everybody loves this guy. He's great. All the bulls are like, yeah, did you listen to Mike Wilson? And, you heard it where, I don't believe that. That's not going to happen. We're not going to, you heard that months ago. And he's been right, and now they're like, oh, no, now you got to listen to him, which, I always find funny. But the Bulls are kind of celebrating Mike's bullish call, even though, if you look closely at what he said this is a bear market rally. And we've seen these sentiment indicators. They're extremely pushed to one side where we should have rallied for a little while, I guess. And we've seen a couple of rallies here and there always fall off, but they get to the point where everyone's leaning to one side. It's so bad. And, so all you need is a little bump up. And what do you have? You have everyone trying to cover their shorts. I saw an interesting post on Twitter a couple days ago. This person posted data on previous market crashes dating back to 1872. I think it was 26 of them. The person, I forgot his name, but it was a good post. I think he's a good analyst. But he said, at a drawdown of 28% for the S&P 500, okay, this is before this rally, the stock market is now priced into 85% of a typical bear market, which typical bear market, you see a 33% decline, and is 78% of a recession where, during recessions, The S&P 500 declines around 35% on average. So he said with 20% of the way there, meaning that there's very little downside if you're looking at past markets. So I love data because it's factual. It's data. Yet you can interpret it any way you want. And that's what separates the good analysts from the bad analysts. Where economists look at data that's factual, it's their opinion on what's going to happen, which is nonsense. Right? That's what we see. So they're reporting stuff. The last time we saw this was this year. And then when this happened. It's easy to say, okay, this always happened in the past, and this is why it's going to happen this time around. But you have to interpret it. You have to look at it a certain way, because everything this guy posted, and it was a great chart. It was awesome. But looking at it makes you think you should be buying stocks like crazy. Go all in. Again, simply based on that screen. And my question, and I actually retweeted this with a quote, I asked him on Twitter, because the whole spreadsheet, it includes these crashed average market pullback, average PE before and after the market crash. It was actually a cool screen, but I asked him, I said, in these past, and I quoted typical bear markets, because these are the typical bear markets. He took the average of them. Again, includes 26 of them dating back to 1872. So I asked him, in these past typical bear markets, can you list the ones where the Fed was planning to aggressively raise rates for another 3 to 6 months and reduce its balance sheet by trillions when the market was already down 20% plus? I said, don't bother looking. There's no comparables. And this is where I think we run into problems here. Because we look at data and we say, wow, you should be buying it. And, these typical bear markets, every bear market is different. This one, we've never seen anything like this. I'm just talking a bear market, but we've never seen the amount of money flooding into the market due to COVID, 0% interest rates this long. It's crazy. So you're watching this and saying, wow, the markets are up and we're doing okay now. And they're pulling back a little bit. I'm doing this in the middle of the day here. And they went up sharply yesterday. They were up a lot more than what they are now. I don't know where they're going to finish. Maybe they finish much higher. Maybe they finish much lower. But they pulled off their highs. The 10 years now back over 4% as I'm doing this. When I already started this, it was lower than 4% and much lower. I think it was 3.8. There's a little bit of reversal going on here. But for those of you who think this rally is sustainable or even normal, where stocks rise by 6% in 2 days, it's not. Not when the Fed's expected to aggressively raise rates over the next 2 months. And let's break this down. So the past 2 days, the major indices rising substantially. Again, just 2 days substantially. But it's not being led by a sector. It's not being led by certain, hey, Microsoft reported great earnings, so it's going to bring up the whole sector within cloud or, software or whatever. It's not that. It's 2 days in a row where we have 10-to-1 days that we've seen 10-to-1 advance over decliners. This is extremely, extremely rare to see a market like this where everything is going higher, not just specific sectors. It's extremely rare where this type of event never happens during normal conditions. It happens when we have a lot of confusion, a lot of shit going on, big sell-offs, and it rebounds really quick. That's typical, very common in the middle of a bear market. If we look at last quarter earnings season, exactly where we are in earnings season today, just when the banks report, a few companies are starting to report, what happened? So 3 months ago, look at mid-July. We're expecting earnings to roll over, and they didn't. Most companies, I believe it was 68% of them, beat estimates. That's around average when you look at the last 5 years and 10 years, just to let you know, that 68, 70% usually beat those earnings estimates. But let's talk about these estimates. Because, yes, again, that data is a fact. And you'd be like, wow, they're beating estimates. That's awesome. But these estimates were revised lower into the last quarter, into that earnings season. So it wasn't hard for these companies to beat those revised estimates. And it was like, oh, even though the Fed's raising rates, the economy's doing fine. These companies still have pricing power. They're doing great. And the S&P rallied 10% into August. And then fell sharply from 4,300 to 3,600, which was a 16% drop. So we saw a 10% rally in August and then a steep drop of 16%. And remember, those companies that rallied alongside with everyone else include Nike, FedEx, CarMax, Levi's. Again, these names rallied sharply, only to crash after they significantly lowered estimates. And they reported what? 2 weeks ago, 3 weeks ago? They were late reporters? This is where FedEx, again, is another company that rallied in that 10% rally, who turned around and reported earnings pretty much a month later and removed its guidance completely. Now we're heading into this quarter. Same thing. Banks are being celebrated because they beat estimates. said earlier, these are the companies that are first to report. If you look at these estimates, they're showing profit declines on average of 15% plus from last year. That's massive. So yeah, they're beating, but they've been low, and they've been reduced significantly, those estimates, heading into this quarter. I know this is data that we get. You don't see this. They don't report on CNBC. They don't report on a lot of the free sites where JP Morgan says, hey, we're lowering estimates. We're lowering estimates from 505 or 510 to 440 on Disney. You don't know that happened. But a lot of companies are doing the same thing where you're like, wow, Disney's trading, and you look like 2 months ago, you're saying Disney's trading at 21 times forward earnings or 20 times forward earnings. Well, those forward earnings for 2023 now just went from like 515. Morgan Stanley is not the only one. You've seen other companies low. Now that estimate's 440. Now this company's trading a lot higher when it comes to a PE because earnings are a lot lower. And then when they go into the quarter, they'll report 445. And it was like, Disney beat. They're fine. That's the game that's being played right now. But at the end of the day, the earnings are the earnings. And what I mean by that is 440 is not good if you thought they were going to report 525 2 months ago. So if they go 440, they go 440. It's still 445. That means, you're looking at Disney trading a much higher multiple than you originally thought 2 months ago, simply because these analysts are lowering estimates and nobody sees that. You only hear when they upgrade and downgrade and make major calls. That's what you hear on CNBC. You don't see them all lowering these estimates into the quarter. And this is very, very important for you to understand, because it makes it easy for these companies to beat their revised estimates. And now you see the market rally, and it may continue. This is one of the things I was afraid of with earnings, but hey, you know what? Earnings are holding up a little bit, just like they did last time before you see more companies lower in between quarters. And it might hold up into the first week of November, maybe second week, right? Because we have the elections. Republicans are now projected to take the Senate and the House, which was not the case 3 weeks ago. I mean, it was kind of close, and they were saying leaning Democrat. I mean, at least now for Republicans to take the Senate. But now the odds are increasing a ton. They're really shifting right now. And a split government's always good for stocks, and that might be a catalyst, right? But let's talk about what happens after the elections. Now earnings season's over. What's going to happen? The Fed's going to continue to aggressively raise rates. They're not stopping, especially since the core CPI, that's the core CPI, right? So you have the regular core, the core CPI strips out food and energy. And then you have unemployment, right? Those are the two gauges is really CPI. But the number one thing is the core CPI. That is what's the most important thing to the Fed when they're looking at an inflationary indicator. Number one by far. And this indicator, it hasn't peaked yet. We haven't seen it peak. See, regular CPI peak and come down. Core CPI is not peaked. In this market, it's still going higher. So what are we going to do? The Fed, obviously, 75 basis point hike in November. I believe that's November 2nd. And then another 75 basis point hike in December, taking us to an incredible 4.75%. Guys, that's 1.5% higher than where we are right now, where the housing market is frozen. I say frozen from a lot. You're going to see, people with cash, yeah, that's fine. They'll buy a house. People that have to move are going to pay high. But most of it, if you listen out there, even the people that were doing great are saying, hey, we're starting to see it now, and we're preparing. You're definitely not seeing that market where money was free and they're buying houses like crazy. I mean, that mortgage payment is significantly higher now. Significantly. All of you know that if you own a house. Look at the current loan, how much money you own in your house, or the loan, the average loan is $400,000. Right now, that's average, with the average home price around $500,000. It's down from there, the average home price, because home prices have been declining in most areas, 90% of the areas in America. But if you look at those numbers, holy shit, just put in a calculator. You'll see the difference between a 3% rate and a 7% rate, or even a 5% rate, where you saw a dramatic slowdown. Now we're at 7%. And you're looking at today, the Home Builder Survey. 10-year low. This is the Home Builder Survey. This is what they're saying. These are the people that are saying, hey, over the next 6, 12 months, what we see in the market, how we're structuring our CapEx. And the NAHB came out and said, this is unsustainable. They actually used the word unsustainable, meaning that we're going to see markets come down much more, especially even right now if the Fed stops. But rates are going much higher. Mortgage rates have a chance to go much higher if the Fed continues, which, again, they are. And you look at housing is one of, if not the biggest drivers of GDP. Look around your house. If everything you buy is the reason why appliance makers are warning, a lot of companies are warning, lumber prices are crashing. I mean, that filters into, you know how many jobs? Holy cow. And how many items that you're buying, that you're purchasing, that you could put on buy now, pay later. Holy shit, was that not the sign of the top of the market? Everyone jumping into buy now, pay later. God, that doesn't get worse than that. That should be, I think that's the ultimate top right there. When so many companies coming out of that a year ago, 2 years ago. Holy cow, it's crazy. And then let's talk about the rest of the world, who's saddled with the highest debt levels in their country's history. And I remember when it used to be, hey, if you hit 100% debt to GDP, it's bad. These guys are well past that. Some 200% plus. Well past that. So what do higher rates do? It means much higher debt payments on their debt. But it's already crushing all developed countries and tons of emerging markets. And rates are going even higher. This is why you see a central bank like the Bank of England, major central bank, raise rates on September 22nd and then start buying bonds 3 weeks later, which is easing because pension funds are getting margin calls. And I'm hearing reports like, oh, everything's okay right now. We're good. We figured it out. You figured it out? In 3 weeks, you freaking figured it out? Really? Because rates are about to surge from here. You better I don't know what you figured out or what you did or how you hedged. I have no freaking idea, but everybody believes, oh, everything's okay now. It's not like, hey, this happened, long-term credit, or the credit crisis in 2008 where everyone was fucked and everyone's like, holy shit, this market's coming down, and we need to do something. And then you bail out the system. There's no bailouts here. They're just rates that continue to go higher and higher and higher. And they have their own problems in Europe when it comes to energy, which we all know due to Russia. Especially Germany, supplying 40% of their energy needs. Good luck with that. And you're trying to place sanctions on Russia? You're trying to mess with them? Crazy when you think about it. But that's what happens. And that's what's happening now. And I think that's a big point that people don't understand. Like, even if the Fed stops, you think everything's going to be okay. This is happening now. And the Fed's going to go 1.75% higher by the end of this year, or 1.5% higher by the end of this year. Maybe they do a 50 basis point hike. Big deal. You're still going to continue to raise probably through March. And if you think this rally could be sustained, they're probably going to go even higher, well past 5%, thinking, hey, the economy's fine. Look at the markets. Let's keep going. But what happens with these other countries? As things get worse, and they're going to get a lot worse, they start flooding into the dollar. They're going to drive it higher, at least into mid-next year. As we see, the higher dollar is bad for equities. Really tell S&P 500 companies generate 40% of their sales overseas. You want proof? Look at Nike. Look at the data. They said they're going to lose $900 million in EBIT. That's earnings before interest and taxes. That's a pure number, right? It's EBIT, EBITDA, and then you can report earnings and you can manipulate that last number so much. But this is EBIT. That's $900 million next year simply due to currency. And I said, wait a minute, how much are they going to report in EBIT, earnings before interest and tax? How much are they going to report? And when you look at it, that's close to 20% just on currency, not demand. That has nothing to do with inventory levels, which they reported the highest inventory levels, I want to say, on a dollar basis, easily by far in the company's history. Was it $9 billion or something like that? 44% inventories were up. We're talking about currency here. You could say, well, that currency could lead to less demand because if the dollar's going higher, it means other countries are doing bad, which is reducing. I get it, but you see what currency does. And we're not talking about the war. We're not talking about Fed. We're just talking about currency issues as the dollar goes higher and higher, which how can it go higher from here? Every other country, as rates go higher, just going to be like, hey, we're good, man. We're fine. Our debt doesn't exist. We're good. They can't print money anymore. But as long as the Fed is aggressively raising rates and shrinking its balance sheet by trillions and not even close to lowering rates, because you still haven't seen the core CPI hit a top yet, it's going to be impossible for stocks to go up long term in this type of environment, since demand's going to continue to fall off a cliff. It's already fallen off a cliff in housing, autos, semis, which found in every tech gadget and product. There's certain sectors that are going to have pricing power. You have not Disney, you have Pepsi, you're going to have Coca-Cola, you have some of the consumer staples, healthcare companies. When you're getting a check from the government all the time, they can raise prices as much as they want. So what happens with tuition as well when you basically allowing kids to take out $200,000 loans to become first grade teachers. This way they're paying that off when they're 68 years old. Nobody tells them, right? They don't care. The system doesn't care. Politicians don't care. Give them $10,000 to reduce their debt by 5%. Good job. Oh my God, now you're going to buy their vote, hopefully. No coincidence you're doing all this stuff just ahead of the election. But getting back to earnings here, right now, earnings are expected to go up 7% in 2023 from this year. I'm not kidding you. They're going to go up 7%. Earnings are expected to increase 2% in 2022 in this environment. But if you look at that number, which I told you, it includes energy, whose profits are expected to pop, I believe it's over 100% year over year. And if you strip out energy, and I'm not stripping out like, hey, I'm stripping out this, staples, tech. I mean, I think there's 11 sectors within the S&P 500, and energy still at this level is not a big component. It used to be a huge component when Exxon was one of the top companies, and now you saw the market caps of these are still, pretty high, but they're not $2.5 trillion, $3 trillion where Apple, Microsoft got to. So energy is a very small part. It's still a relatively small part of the whole S&P 500. But if you exclude energy, S&P 500 profits are down 4%, or expected to be down 4% in 2022. But yet it's reporting that it's up 2%. And now you're reporting that on average, earnings go up 8% on average annually. Right? 7-8% on average annually. They've gone up over 20% last year. And then in 2018, when Trump lowered corporate taxes, it went up about 26-27%, but on average. So you really think that next year is an average year where rates have never been close to this high? You really think it's an average year where we're going to see earnings pop 7%? Are you out of your mind? These estimates have to be revised sharply lower. Now, management teams and companies, they're really smart. They know how to pad their earnings, especially in the short term, by cutting employment. Every technology company, right? They're cutting jobs, cutting divisions, cutting CapEx, marketing budgets. But it's not going to bring back demand, which is falling off a cliff with rates at 3.25%. What about when rates go to 5%? What about when they stay over 4.5% for all of 2023? What do you think is going to happen? So you see these companies' earnings season doing a good job thus far, beating estimates which were revised sharply lower over the past 2 months. You let me know, how in the hell will these companies continue to grow earnings into next year? I have no idea. And this is what I do. And that's what's projected. The S&P 500 company to generate all the earnings put together, $240 in earnings for 2023. So when you say the S&P 500 is trading at 17 times, that's the number they take. They take all the earnings, combine them, which is 240, and it's the price divided by that number, and that's how you get the P for S&P 500. So you're used to seeing the P for S&P 500. You say it's trading 17 times, 16 times, 15 times. Again, it's just a number, right? Or forward earnings. The average has been, 17 times over the past 5 years, 15 times over the past 10 years. That's what the S&P 500 trades. And right now, based on 240, we're trading at about 16 times forward earnings. So we're on average. Stocks are a buy. That's all you see. But let's dig into the 240 number. Because in 2019, year end, just before COVID hit, earnings peaked at 159. At the end of 2018, they were 160. The market surged in 2019. That's why I went from 20 times forward earnings to 25 times forward earnings. But we peaked at earnings in 2019. What changed? A lot. What changed for earnings this year to be at 226 for 2022? 226. Again, they were 159 in 2019. What changed to make these projections to go to 240? That's what we're expecting next year on growth, 240. $11 trillion flooded into this market. This is fiscal and monetary. Rates brought down to zero. And then when the market opened up and everything went back to normal, which was pretty much close to the end of 2020 into the first quarter of 2021, all asset prices hit record highs. What did our government do? Spend another $2-3 trillion. That's what made earnings go to these levels at 240. So these earnings included a massive pull forward in demand post-COVID. Due to zero rates, $11 trillion added into the market. And now what's the Fed doing? They're raising rates at its fastest pace since the early 1980s. It's aggressively shrinking its balance sheet in an effort to remove the $11 trillion from the market. So you should say, well, those earnings should go back to 2019 at 159. But even at those levels, rates were below 2%. We're going to 5%, guys. That's a massive difference. How could that be sustained? I mean, companies could only cut so much. When you have no demand, they're going to cut. And yeah, it might result in earnings doing well, and but you're going to see it on the top line where revenue is going to shrink. They're losing pricing power. You're seeing it. I mean, a clear example of the demand destruction is the relief in the supply chain issues, which you're seeing tons of relief in, not perfect, but tons of relief in these things. Again, I see all this data. I showed it in my newsletters. Goldman Sachs reports it, but other companies report have been doing this for 30 years. So I was easily able to tell you how Ford and some other car companies were actually lying, saying, hey, it's going to ease in like 6 months. Second half of the year. They said that 18 months ago. It wasn't easing. They were lying to you. That's why their stocks are getting absolutely hammered much more than the overall market. So now you're seeing demand destruction. And it's going to get worse. So I don't want to sound the alarm here and go crazy, guys. I'm just telling you what I see. It's the Fed. As long as the Feds continue to raise rates, shrink its balance sheet, remove trillions from the market, rallies like this are going to be hard to be sustained. And you're going to see massive rallies because everyone now, you're going to see the market's coming down now a little bit, definitely off its highs. Maybe it goes up for the next, but you're going to see these short positions start coming back in because it just can't be sustainable. There's no way we can get to that 240 earnings number. There's just no way. And remember that 240 number because that 240 number is going to be at 220 next quarter, and everyone's going to say, look, we're beating estimates. Remember, I'm going to tell you what that number is. I guarantee you it's going to be well below 220. That's how much estimates are going to be lowered going in. So that means we're not going to see 7% growth. We're going to see flat growth. That's what we're going to report early. And through 2023, you're going to see it get lower, lower, and lower, probably below 200. And then you're going to say, wow, earnings are going to decline 10, 15%. And that's when we'll be closing in the bottom. We'll see if that happens. But for now, be very, very careful. It's nice to see a rally in stocks, and you should be a little long. We're a little long in our newsletters, and you have good positions you're holding on for a long time. But my thesis on equities falling much further in here over the next 6 to 12 months, very, very much intact. Nothing's changed. As long as the Fed's dead set on aggressively raising rates, which they are. And I know most of you are concerned about your portfolio. You listen to this podcast, more downloads than usual. You're watching financial media channels like CNBC, Fox Business. There's one quick thing you should know. Especially for those bulls that you watch on TV who said, we bottomed and the Fed tightening, all those negatives, everything in the market, it's already priced in. Most of these so-called experts you watch on TV were children the last time we were in an inflationary environment. They were children, including myself. And more than 70% of these people, if I had to guess, I'm throwing that number out there, I'd say at least 70%, have only been a professional money manager, analyst. We know who the legends are. But a lot of these guys have been professional fund manager, analysts for less than 12 years. So they never in their career operated in an environment that didn't have super low interest rates, again, which were near zero for most of their career, or when the Fed was no longer providing easy money, constantly buying bonds in the open market. They've never been in a market like that. They've always been in a pure bull market that every decline will be met with buying. It's significant. Because these Fed policies, they created one of the greatest bull markets in a generation. 12 years with what? 1 or 2 quick hiccups? I mean, even COVID was a hiccup. We bounced back immediately when it comes to the markets. You're like, oh, the Fed's there. I told you stocks are going to come back. 2008, 9, I told you stocks are going to come back. You have to buy. You always have to buy. Well, they came back because the government injected hundreds of billions of dollars into the system in 2008, 2009. If they didn't, we would have seen 30% unemployment, and a lot of people wouldn't get money out of their banks. If they didn't inject $11 trillion, we would have saw probably 30% bankruptcies. You had nobody models for zero revenue or 90% or 80% revenue decline. I look at Delta, look at the cruise ships, look at a transportation company, look at everything across the board. Hotels, I mean, you saw declines of 80, 90% when we shut off the economy. And a lot of these guys were leveraged through the roof because we had easy policies. So a lot of these companies in a regular market with no Fed go bankrupt. But they didn't, because the Fed was there and said, hey, we're just injecting $11 trillion into this market. Everybody be fine. Checks directly to people. We're not even going to the banks this time. Forget about that. Let's go directly to people and let them spend it like crazy. That's gone. You don't have that anymore, guys. It's gone. The Fed always there to print, bail out banks, flood the market with cash, buying bonds. Again, they're no longer there. And a lot of people operate in this market, especially if you have 10 years of experience, which is a very long time, they've never seen this type of condition before and never studied it. And so not only is it scary where equities could fall a lot further from here, but even if the Fed pauses, which seems to be the bullish thesis here, we're still going to be at 4%, at least 4.5% the Fed funds rate, which was 0 12 months ago. So if they pause, how could you see equities reaching new highs without the help of the housing market, without the help of IPOs? And I mean, where are IPOs? SPACs are dead. Did you see Intel's Mobileye IPO? What a great purchase by Intel in 2017. They paid $15 billion for it. Last year was valued over $50 billion. Why Intel didn't do the IPO? I have no idea. Why are they waiting until a global recession to do the IPO? I have no idea. But right now, that valuation is $16 billion. That's what it's going to come out, $16 billion. You could have came out $50 billion, which most companies, if you look, was how they came out in SPACs and IPOs over the last 18 months or pre-March when the market really started getting hit. But if you look at all the IPOs that came out before that, those are the ones, just like Mobileye, that fetch these crazy valuations that came out as IPOs. And what are they? They're the ones that are down 70, 80%. This is the new market. I have people coming to me from crypto that have great ideas and say, how much you looking to raise? Well, we're looking to raise about $3 million with a $20 million valuation. How much revenue are you generating? Hardly any. Forget it. Throw it out. No one's investing in you. You might go to the retail crowd, maybe do a Reg A filing. Maybe they'll come in because people, they're not smart enough to look at your financials. But there's no way. I said it's a different market now. You're lucky if you get a $5 million valuation with no revenue. And that idea better be freaking great. But you know how hard it is to raise money? Even with metaverse projects where you saw $170 billion come into this market. And a lot of projects getting funded in Web3 still. But you know how hard it is to raise money out there? I mean, this is what's going on. So if the Fed stops, it's not like all of a sudden the economy is going to get better. Rates are staying where they are if they pause, and they're going to stay there for a while. And when do you see them easing? I don't see them easing until 2024, at least, unless we get an ultimate market collapse, like a real crash from 30% from here. Then the Fed might be, holy shit, we went too far. Then they'll realize it. I mean, there's definitely deflationary indicators. I saw a guy on CNBC today highlight deflationary indicators. If you use the Case-Shiller to calculate the CPI, it would show, negative and going down. You're right. That's what my argument was months ago. But the Fed doesn't care. That's not what they're looking at. So they're going to continue to raise rates because the core CPI has not peaked. And unemployment, it's staying stubbornly low for now. Even though it seems like every company is laying off employees, every large company, especially in technology, hundreds of them. That's about the Fed. And going back to this rally real quick, what you're seeing, a 6% gain. And you're seeing the market surge, right? And 6%. Again, they are still coming down a little bit from its highs. This is the number one reason why you should never, especially as an individual investor, ever short the markets. And you could be right and predict a 20% decline over the next 12 months, but the stock market can go up 20% before then. I mean, you look at the NASDAQ was wildly overvalued at the beginning of 1999. Wildly. Everyone was calling, and it started to decline a little bit, then came back, just for 1999. Everyone was like, oh my God, the dot-com bubble, these things are trading at 25 times forward earnings. It's crazy, at 20 times forward earnings. Most expensive valuation, people shorted the market. You know what happened? The NASDAQ doubled from 1999 to 2000 before declining by 77% the next 3 years, 2.5 years. So yeah, you're right, but you got to annihilate you sleeping on a park bench because you shorted the market. And simple because you got annihilated in an instant because stocks can pop 10% in a bear market rally before heading sharply lower. And like you see, it can happen very quickly. That's why I've been pitching buying long-dated puts that go out for 12 months. It's a year. We're only going to lose the amount of money you put into a trade, so you don't care what's going on right now. You don't care about the rally. You're not glued to your TV calling your broker to buy back every position that you short and hurry up as fast as you can and scared shit and losing money. You're basically betting that the stock or ETF that you're buying from this put will decline 15% from the price you bought at over the course of a year. And if it declines further, you're going to make an absolute killing, which we've been showing. in Money Flow Trader, which is up 30% on average, and annualized, each position is up more than 100% because she's booking these gains within months. This is Ginny at Terra Nova. When you see a rally like this, it makes my mouth water because it's going to provide you even more opportunities by long-dated puts where the pricing is going to be much more in your favor. So if all of you took me up on an offer for Money Flow Trader, one of the best option market specialists you're going to find, who's Ginny at Terra Nova, you're actually loving this rally. It's what you want to see. These big moves higher very quickly, right? Which opens the door for much, much greater returns. If you believe the market, individual stocks will fall 15% from here over the next 12 months. That entire free presentation on this, I know a lot of you have seen it. Some of you are still asking. Just go to CurzioResearch.com. It's for free. For those of you who didn't see it yet. I show all my data on why earnings have to collapse from here. It's not factored into the markets. It's going to drive stocks much lower through 2023. And I also provide a special offer for Money Flow Trader, which retails at $5,000 a year. A lot of people asking me and said they couldn't afford it. I said, okay, here's what I'm going to do. 3 months of $499. And that's what our presentation was, a special briefing was about. And a lot of people took us up on that. And I'm happy you did. Very, very happy. You don't have to look at implied volatility, analyze a stock or sector, figure out option pricing. Ginny does all this for you. All you have to do is open up the alert in your email, go to your online brokerage account, and buy the exact put she tells you to buy. Very simple, and provide a guide for all new investors that simplifies it even more. If you're interested in learning more, go to CurzioResearch.com, click the banner, or just email frank@CurzioResearch.com. We've had a lot of people take us up on that. It's what I'm doing with my money. It's how you can make an absolute fortune as the market falls, which I think is inevitable. Even though you might be looking at the last 2 days and go, holy shit, it's going up. But it's also going to make you sleep at night while you're holding some of your favorite positions, which we all are, even in my portfolios, that you plan on holding for longer than 3 years. It's a perfect strategy for the market conditions, for these market conditions. We're going to see extreme volatility at least for another 12 months, probably longer, until the Fed not pauses. That's not the bull. I mean, markets might go up a little bit. They're not going to go to all-time highs if we pause here. Not at 4.5% interest rates. They're not going to go to highs when we had 0 interest rates. It's not going to happen. The earnings aren't going to be strong. There's no way. But until the Fed actually decides to lower rates, which we may not see until 2024. So a lot of stuff there to digest. Be very careful. Again, I'm glad for those of you who took us up on the offer. I think it's going to be the best investment you ever made. It's the lowest I can go. And if you have any questions, comments, I'm here for you. FrankCurzioResearch.com, especially with markets like this that are all over the place, have you confused, lots of news going out. And this is on the front page of every paper, not just financial media, how the market's going up and now they're coming down and they're crashing. What do you do with your portfolio and all this shit? Everything gets amplified because they want you to watch their programs and read them, and the headlines and stuff like that. It's very confusing. That's why you probably listen to this podcast more than ever. Just be careful out there. What you're seeing in the past couple of days is absolutely common in bear market rallies. Maybe it continues for a little bit longer, but you just have to be careful here. So again, I'm here for you, FrankCurzioResearch.com. Really appreciate all the support. I'll see you guys next week. Take care.